Welcome back, you beautiful people, to the Real Collective podcast. As always, I am joined by my illustrious colleague and co-host, Kyle Miller, who I got to see in person, live and in person today, and one day only. My goodness, it was great.
Black Friday sale.
Yeah, 2 cows for one. Kyle, how you feeling, pal?
Good. It's cold out. It's here, but it's sunny out at least, so we'll take it.
Maybe it's cold outside. Let's cancel that song. Little too close to home. As always, hit that like button, subscribe to the channel, share this with someone who you think might be interested in this type of conversation. If you're listening on Apple Podcasts or Spotify, thank you very much for tuning in this week. And if you'd like to schedule an appointment with Kyle or I directly, you can do that in the Calendly links below. We wanted to take a little bit of time at the beginning to talk about some new regulations that are about to hit. There's some money regulations that are about to hit. I think it's Jan 1 that's coming into effect. Yeah.
The charter?
Yeah.
Yeah, I don't even remember what day it is because I don't care. I'm straight up like this. Yeah. So if you're listening to the news this week, it'll be all over. It's been all over social for a while. For a while, couple days. With this new Canada mortgage charter, which is absolutely nothing. Like it's nothing. It's absolutely nothing. There's like 6 main points in it, and our illustrious deputy premier and finance minister was patting herself on the back pretty hard for being how cool. And this isn't a political thing. It's just this is how politicians work. So it could be anybody, I guess. It just happens to be her. And they're like, we're going to do all this cool stuff to help people who are in a jam. And 5 out of the 6 points already exist. They literally were just like, yeah, we'll do that. And then as mortgage people were like, but we can already do that. So where's the help? And they're like, oh yeah, then there's this one other thing that we'll encourage banks to do. Thanks. That's super great. Like they were talking about, I think the quote was like, at-risk Canadians will be allowed. At-risk Canadians will be allowed to make lump sum payments against their mortgage to bring down what they owe to help the amortization stay along, in line. And it's like every mortgage forever has had lump sum payment privileges, which means you could be doing this anytime. So that's not new. And by the way, if you're at risk, how do you have the money to do this?
Who has a lump sum if you're an at
risk?
What are you at risk of?
Yeah. Well, yeah, if you're at risk of, and that's the thing, at risk of what? Having longer amortization or not making your payment. Like there's different things, right? And I'm not joking about it because I'm like, this is going to be super easy for anybody. Just saying, this isn't fucking help. This isn't help. Like it's already there, right? They're talking about how lenders can, lenders are going to be able to extend amortizations. Oh, you mean like they were doing in COVID? Because they did this already. Like this has already been happening, right? There's already mechanisms in play for this. They were talking about how, oh yeah, but now lenders are, sorry, I get all fired up apparently. Mortgage holders who have default insurance can now switch their mortgage to a new lender, and they don't have to use the stress test. Okay, cool. Funny thing, 35 days ago, OSFI already did that. So where's the new? Just wondering, right? Like it's just it's so annoying, so blatantly annoying.
Here's my thought, and again, this is going to get a little political. It would be the same comment regardless of what side was in power. It sounds like, hey, here's a pretty package that I've put together of all of the things that we can already do, but I'm using that as a platform to say why I'm doing such a good job. So when it's time to reelect me, I don't even know who the person is who's making these decisions, what side they're on, or anything like that. But I think that's what it is, right?
Oh, it's 100%. That's what it is. We're in a jam. We've done nothing but stoke the fire. Now here's all this cool stuff we're going to do, and we're just going to present it like it's our great idea, when in fact it's been there for a long time. It's useless. And like, sorry, those items are not useless.
Right.
They are just not new. And if anything, the only positive here is that this will bring to the forefront to some Canadians who haven't been thinking about it that these things are available. They've just been available the entire time. The
Right.
entire time.
Which is, you know, a great marketing piece put out by the government of Canada or whoever.
Sure.
That's,
Yeah.
that's like
People are going to, I mean, we've been picking it apart, but it's like, yeah, great. Okay. So you put it at the forefront that they're there. Congratulations, but don't take the credit for it. Right. I'd sooner them send out an email and say, hey, we'll, you know, we encourage you guys to talk about this stuff. Like that would have been better use of that time is to say, hey, all you mortgage professionals and banks, just go tell people these 6 points. Okay. Because we're supporting that. But you guys already do that anyway. Yeah.
well, that,
Oh, yeah. The best one. Yeah. One of the best ones, which is awesome, was they're like, we're essentially they're encouraging the banks or they're encouraging the banks to do this is reach out to clients 4 to 6 months before their maturity date so they know what their options are. That's called a renewal letter. Everyone everywhere has got one of those always, not just because times are tough. Like, what? Thanks. Thanks so much. Oh, just trying.
hey, you know,
Anyway.
times are tough, and I know you don't have a lot of extra money, but what we can do to help you out is with all of that extra money that you don't actually have, you can use that money that you don't have and pay down your mortgage so that you don't have to pay your mortgage for as long. You're
Yeah.
you're welcome. I know you don't actually, we're not going to give you anything. You don't have anything, but what you don't have, you can put down towards your mortgage.
We'll let you. We'll let you.
What you
Yeah.
do. Yeah.
That's the best part is that's in the same week. That's in the same week where there was a $1,700 a plate, $1,700 a plate fundraiser where that party was going to talk about how we're going to make life more affordable. Like, this is amazing. This is so amazing. I'm like, this has been like, that's 2 in a week. I'm like, yes, good job.
Hey, you
Anyway,
know
that's
what?
the
When you live in district, 6 or 7 or 12, like you and me, all we want to do is just get to the capital so we can, have those $1,700 plate Hunger Game meals. That'll be.
yeah. May
Listen,
the odds be ever in your favor.
yes. I wish I remembered how to do that whistle. Uh, the
Yeah.
bright news, bright light. We'll talk about mortgage wise just before we shift over to talk about TRESA, which by the time this video releases, TRESA is going to be close to in full swing, or at least beginning swing. Like you called, TD dropped their fixed rate by 27 basis points this week.
Yoo-hoo.
So
Just on the 5 year though. Just on the 5 year though.
I think on the 5 and on the 3 as well.
I'm 5 and 3. Yeah.
So that's the beginning of that fixed rate dropping down, because I think they're the first of the 5 majors to do it.
Yeah, the non-bank lenders have been doing it for a little while. For over a week. They'll usually jump first.
Yeah.
So yeah, it's a sign. It's a sign. It doesn't save a ton of money, but it does increase it's the sentiment. It's the fact that it's happening. And if that continues to happen, then we'll see it. If you don't follow Ron Butler on Twitter, yeah, he's on TikTok too. He swears a lot on TikTok, so you gotta be okay with that. But on Twitter, he does some good threads every day. And love him or hate him in our industry, like he's a disruptor. But he's been in the game a long time, and I got a lot of respect for what a lot of the facts he spouts. I may not like his delivery, but what he says is typically pretty solid. And until the key is going to be to see a 4 in front of that interest rate. If we can see a 4 in front of that, we'll see a decent pickup, and we're that much closer. So I think once we get through Christmas and they look back, like it's a lag. So it's going to take us a quarter to figure out what's really gone on. Once we get through Q1 of 2024, which will show what happened at the end of 2023, then we'll see where those rates go. And if there's a 4 that gets in front of those especially the 5-year fixed, it'll be fired up. I think people get a little fired up. So, and that's coming from, I'm regurgitating what Ron Butler was saying there.
So four at the beginning means 499, right?
Yeah, like, yeah, 499, 494, something like that. You see it start with a 4. People will get excited, and we could see some activity for sure.
What I wanted to talk about was TRESA, and that's the Trust in Real Estate Services Act. There's been a lot of training, chatter, conversation about what it means. The regulation has been put out. They've shared some of the forms with us. They are amending the forms as we move forward. I think we're going to start to, figure out. Oh, well, there's going to be some nuanced things that you might not understand, and still until we start to do it regularly. But as of December 1st, 2023, we will be governed by TRESA, the Trust in Real Estate Services Act, as opposed to REBA, the Real Estate Business and Brokers Act. So it's going to be some changes. The real thing is, and I've talked with agents in our office about, oh, well, what about in this scenario? What about in that scenario? So there's a few changes that are happening. One is that we will be conducting ourselves with what's called, at our brokerage anyways, designated agency. And so the idea is, in the past, leading up until now, if you hired a real estate agent, you actually hire the brokerage. And therefore, every single person who's in that brokerage owes you that same fiduciary responsibility as the agent who you hired.
Okay.
Got it? You there? Okay. So let's say Joe Blow hired me to help them sell their house, and there's a brand new agent who just started working at our brokerage who doesn't know Joe Blow, has no whatever, and says, hey, I want to do an open house at that house you've got, 123 Main Street. They would legally have to go into that house and represent the best interest of the seller. That's
okay.
That's
okay. That seems to make sense.
Right.
Like your expectation.
Right. Now, there will be a designated agent who owes the client fiduciary obligations. So
they hire you, and if you say, I can't do the open house this weekend, but this newer agent, Jeff, can do this house weekend, what's the change? What happens?
Jeff does not owe the client the fiduciary obligation, i.e. does not need to represent that seller's best interest.
And why is that better? That's my question.
It isn't. It's different, but it isn't better. What it is actually more in line with what happens. Okay? Because you walk into an open house, and normally what happens is the agent says, look, I don't really care about selling this open house. What I want to do is I want to pick up buyers. Right? And now there's a clear understanding about what really happens as opposed to what the consumer thinks should be happening. Now it gets one step further, okay? So one step further is this. Jeff brings an offer on that house because someone at the open house said, yeah, I want to buy it. I don't have a real estate agent. Jeff, help me buy this house. Okay, Jeff brings an offer for the house. In the old system, we would instantly be in multiple representation, where because the brokerage is the agent, the brokerage is offering agency level services to the seller. And if the person who Jeff met at the open house wants to buy that house and says, yeah, I want you to treat me as a client, I want all of the good things that come along with client representation. Now Jeff brings an offer. Now we're in multiple representation where there's two primaries, two clients being served by the same agent. Again, the agent is the brokerage, not the real estate agent. Right? So how do you conduct yourself? You can't give advice. You can't tell the client what they should do, either of them, because you're in this multiple representation system.
Now or before?
Before.
Okay.
But that wasn't what was happening. What was happening is I would tell my client what they thought they should be doing. Jeff would tell his client what he thinks they should be doing, and you'd come to an end, right? You'd get to a point.
That's why we hire you.
Correct. So what this is doing, what the Trust and Real Estate Services Act is doing, is setting the parameters to say, hey, here's how you operate. Here's how you operate as real estate agents. You don't deliver customer service to people. You all try and do the best that you can for clients. So you can serve your clients. Your client, the general public can either be a client of an agent or they can be a self-represented party. That's it. Those are the only two options for people. They used to have the ability to be a customer, right? That customer designation is going away. It gets more confusing because you can also choose to be have limited representation. So hey, you're a client, but I'm not going to give you all of the level of service that I would give to a client because you only want limited representation. What you're allowed to do with consumers versus clients versus self-represented parties, all of that is changing. And there's like, hey, you want to engage in real estate? Before you do, here's a 13-page document for you to consume and decide how you want to be served. So things are going to get you're going to get funky. They're going to get messy. People are going to be confused. And I'm sorry to say, but a lot of the agents aren't really going to follow all the rules. They're not going to know the rule changes.
Wow.
So just finishing. Well, I'll take a break, but I'll finish the second half of the explanation of, hey, now we have designated agency at our brokerage. The listing agent is representing the best interest of the seller. The buyer agent is representing the best interest of the buyer. And even though they both work at the same brokerage, the brokerage, the designated agent makes it so that the agents can serve the clients the way that they're expecting to be served. There's a lot.
Clear.
There's
super clear.
Yeah. Oh, buddy. And it gets worse. And now this is the real kicker just before we break. Now, if you're a seller and you would like to disclose the contents of your offer, i.e. price, to anybody who's shown an interest in your property or people who've made a bid or whatever, you have the right to do that. That's the big change. The seller has the full right to disclose the contents of the offer to someone else. So
see that I find interesting. We can pick that up in a sec, but that I find interesting. You'd have to tell me why it's totally bad, but
no, hey, listen, I don't think all this stuff is bad. I'm not saying I'm not giving a value judgment. I'm saying it's different. It's all changing.
Yeah.
I'm all for change. Change is good, but it's I think we'll need to do a whole episode on just TRESA and running through different scenarios, the deeper we get into this, because it is messy and it's different, and there's a rollout and there's a 120-day holdover period, and there's a lot of stuff that's going to be funky. So we'll work it out. But we'll come back after the break and we'll talk about Kyle's story time this time, about the hardest deal that you ever put together. That's what I want to hear about. So as always, hit that like button, subscribe to the channel, and share this with someone who you think might be interested in this type of conversation. And we'll see you on the flip side.
This episode of the Real Collective podcast is brought to you by Real Collective. Real Collective brings together best-in-class real estate agents and collective experts in the field to deliver the best possible service to our clients. We govern ourselves with honesty, open-mindedness, and compassion. With diverse skill sets, our agents are able to better serve a wide array of clients, including first-time buyers, first-time sellers, transferees, estate sales, investors, and rural, vacation, and luxury properties. Authenticity and transparency are pillars of our process, which allows us to put our clients at the center of everything we do. Our years of experience and knowledge allow us to deliver prestigious service and optimal results. If you are interested in buying or selling your home, contact us today at realcollective.ca.
Welcome back, you beautiful people, to the Real Collective podcast. Thanks so much for sticking around for the second half. Everybody loves story time. Hit that like button, subscribe to the channel, share this with someone who you think might be interested in some of this beautiful information. And if you're listening on Apple Podcasts or Spotify, thank you. If you'd like to schedule an appointment with Kyle or I directly in the Calendly links below, feel free to do that. Kyle, tell us all about your story about that deal that you put together that you're like, oh my goodness, I can't believe this worked.
Yeah, there's been a couple, because things will happen. For the most part, everything's pretty good. But some things happen where people are aware of and make a bad decision. Some are where things happen where we didn't see it coming. I had one guy, I'll get to the story in a sec, but just to give you an idea, I've had people who have bought cars before closing. But again, lenders can look at your credit report and know that you bought a car, and that car throws out all the ratios, and now you can't buy the house, right? Say it all the time. Cars kill deals. You could buy the car after the house. You can't buy the car before the house, almost always. So there's that. I had one guy who we did the stuff. Everything was fine. But in the period between when we got it approved and closing, like a month, his student loan that he had, Canada student loan, the payment changed because he had a lower payment because of XYZ reason, and that timing that he had it for ran out between our approval date and closing, and the bank found out because they ran his credit again, and it sent the deal off the rails because it like tripled it. Like it went into repayment fully. He was voluntarily paying some, and we were allowed to use that to a degree. There's more to the story, but it tripled his payment, and that killed our deal. And we had to do some dancing to figure that out. Probably one of the biggest ones though was for a self-employed client I had, and they have a company, lots of equipment. And what a lot of people don't realize is that unlike the States, to a degree, at least in the early stages, when you incorporate as a business, it's all still based on you, right? So if you go to rent, you go to lease something under the company name, you go to buy something, finance it under the company name, it's under the company, but it's still based on your personal credit until that company, for lack of a better term, gets to becoming a going concern on its own, where it has money and it can get credit because of revenues and whatever. It's still based on you as the person. Yeah. So client came to me and had like, I don't know, probably close to $300,000 worth of equipment in different loans, right? And company's making money paying the thing, and that's fine. But what ended up happening was, if they're still under your personal name, it's your personal debt. But I mean, you're self-employed. You're not paying yourself $1 million a year, most likely. You're paying yourself 40, 50, 100 maybe, but that still doesn't cover your mortgage and $10,000 a month in equipment payments. Yeah. So we had to get those pulled out of our lending and out of our ratios. But the only way to do that is to match up what's on the credit bureau with the payments in the bank account. But we need to then attach those bank account payments to like actual loan lease agreements. Problem was, the company we were dealing with doesn't match anything up. So the national company has one number for X product. They register it on the credit bureau as a different number. The loan that it's attached to comes out with a different number. And then because they were refinancing and trading in, but it wasn't discharged properly, there was 16, but they only owned 12. I'm going through this stuff line by line, trying to figure out who goes where, what was refinanced, what was sold. Then we're going to the company nationally, trying to get them to send us the right paperwork to show how this works. All the time, we're trying to get this refinance done. It's taking weeks just to get through this. And then there was, but this payment. And I changed jobs here. And all this stuff. Like we were deep. We were deep in that that probably took me almost 2.5 months to actually work through, which is ridiculous. Like that should never happen, ever. But that was one of those ones where you just grind it out, because some deals are onions. They're like onions. Yeah. At face value and at the original time we're talking, everything seems to make sense. And you get a piece of paper, you look at that paper and say, well, what's this? And the rabbit hole opens, right? The rabbit hole opens. So it was a wild one, wild. But 2.5 months of digging paper back and forth through different organizations, credit bureaus, paid for what are called PPSA agreements to get for it read. Oh, just paper. The worst, the absolute worst deal I had to work on personally. Yeah, was probably that one.
What does PPSA stand for? Do you remember?
It's I can't because I never wanted to hear the term again. It's the Personal Property
Services Act?
Personal Property Security. I
Security.
think it's so you get a car, you buy a car, and there's a lien against your car. They register a PPSA against it. So on your credit bureau, they know that that car has a lien against it, right? And then it's a secured asset. It's not like your credit card, which is just, yeah, we like you. Here's 10 grand and go spend it, right?
Yeah.
So, but we had one of those for like 16 or 18 pieces of equipment that nothing matched, and 6 of them didn't even exist anymore, but they still showed up on the credit bureau. So it's payments that don't exist. And then where are they? And then where are they in the bank statements? But then they're seasonal, so they only show up 5 months a year, and then they're gone. Oh yeah, we dug deep on that one, big time.
The equipment was seasonal?
Yeah, because it was a seasonal business. So some companies will allow you to lease, like you keep it for the year, but you only pay them over your busy season.
Right.
Kind of like how farmers have make their payments twice a year, right? When they make their hay and when they collect their milk, that's when they make all their payments, and they have to spread the rest out over the year. Same as these guys, because it was like snow plowing or lawn maintenance or something like that. Yeah, but we dug deep on that one. That was a fun one. I learned a lot on that one, and that was only a couple years ago, so I'd already known a lot, but I learned way more on that one.
Now when you do that work and you get down into it, and you've got like your desk just full of papers, and you've got a highlighter and a pen, and you're like
100%.
Yeah.
100%. I had to go back to paper. I'm usually digital and I'm highlighting stuff in Adobe. This was no, print it all out and just like the notes.
Give me this big desk so I can sit at, and I can pull it from here, and this goes and these go together. Yeah, man.
And literally to the point where the underwriter on the other end was like, Kyle, you need to just break this. They're like, I'm not doing this. Like, I'm not doing it. You figure this out, send it back to me, and I'll look at it. But other than that, I am not touching this anymore. We're done. So they put the whole thing on hold until I could just write the book and say, this goes here to here, to here, to here, to here, to here. And that was just to clean up the credit bureau. Then there was the rest of the file. Like, that was just to make sense of it all. So yeah, it sucked. It sucked. But
what to be said about keeper.
Oh, but and you know what the toughest part is about it though, is that the clients themselves, it wasn't their, like, I'll say this. There's some clients where it's your fault. It really is. You're a shitty bookkeeper. You don't like receipts. I get it. But it wasn't them. It was how the accounting is done at a company over there, and what doesn't get discharged from the credit bureau, right? I mean, I found 4 mortgages on my own parents' house. We bought the house in 2000. There's 2 mortgages from the 80s because the lawyer didn't discharge it. So this is stuff you find out that you don't even know about, and it's not even your fault. We just fix it.
You know what? We had a closing delayed this week because it was supposed to close on Wednesday. I mean, it will close, but same thing. When the title got registered to the current owner, something didn't get discharged, and as a result, they can't close on it now on the way out as they're selling it. So it's like, yeah, you know what? People don't do their job, and as a result, it has these delay things. Like, why not cancel that PPSA after the vehicle's sold? You know, like all these different.
Yeah, 100%. And it's one thing too, is that when people, and again, people expect that everybody's doing their job, and they should, and I agree with that. Sure. But
you're not.
To check your title and stuff is, especially when you're going to do your mortgage, you'd be surprised. It's, I mean, you probably run into it where clients didn't know that Reliance will register a lien against your property for that furnace.
Yeah.
And now you can't get rid of your mortgage because it's registered against the house. Like, you don't know that
Who would?
until you're there.
Oh, that's good. Thanks for story time, Kyle. I appreciate it.
Sorry, that was a long one.
No, hey, that's perfect. That's what we're looking for. That's a good one. I think it's a perfect place to wrap up. So as always, hit that like button, subscribe to the channel, share this with someone you think might be interested in this type of information. If you are looking for the type of mortgage agent who is going to print out paper, old school, and get jiggy with it, Kyle's your man. Hit him up. You can schedule
Go.
an appointment with him directly in the Calendly links below. Friday afternoon. We're getting there. You can do the same with me and the Calendly links below if you're listening on Apple Podcasts or Spotify. Thanks so much. And until next time, keep it real.
Collective.